Great. Thank you very much for that introduction. So let me share my screen. So 1 second. Okay, hopefully people can see that. And I guess I wanted to say, if you're on the call, please feel free to ask questions whenever you want. If you would like to go on camera, that would be great. If the more interactive we make this, the more interesting I hope it will be. So just a quick question. Is my screen visible? Can someone just confirm?
Yes, your sound
Yes.
and the screen, perfect.
Okay. Okay, perfect. Thank you. So let me just briefly mention where my current affiliation. So in addition to teaching at Columbia Business School, I am a partner at QuantStreet Capital. And you can sign up for our email list if you would like at this link, bit.ly/QuantStreet. And just briefly about what we do at QuantStreet. We are a registered investment advisor. We work with clients to understand their investment needs. We work with them to figure out their risk tolerance, their liquidity needs, how much it should be saving, how much it should be spending. Our core approach to portfolio allocation for our clients is we use analytics and data science to construct low-cost portfolios that are tailored to our clients' risk and liquidity preferences. And we work with clients to help them figure out important decisions that they have to make in their lives and their investment lives, things like Roth conversions, when to take Social Security. We work with people and helping them think through venture capital, private equity deals, and so on. So if you would like to reach out and speak to us about some of the things that we do, you can contact us at hello@quantstreetcapital.com or sign up to our email list here at bit.ly/QuantStreet. So what I wanted to talk about today, and again, please feel free to ask questions, and we can make this very interactive if you would like, is how individuals who are not necessarily very conversant in the language of finance should think about their investing and financial planning. So that's going to be the general topic of our discussion. Just a quick disclaimer, as you probably all understand, investing in financial markets entails risks. Any investment you make might lose money. What I'm going to be talking about today is not investment advice. It is simply an educational webinar. And to give investment advice, you would need to talk to someone who really understands about your specific financial situation, your own needs, which I cannot say I do because I haven't spoken with you. So please keep in mind that this isn't investment advice. It's just an educational program. A little bit about myself, so you know who you are listening to. I started off as a professor at Yale at the School of Management. I then, after 2 years there, I took a 1-year leave of absence, or what I thought would be a 1-year leave of absence. I went to work at Morgan Stanley, then at a hedge fund called Old Lane, and then after that at Citigroup. I worked basically the same group of people at all three of those organizations. Now I'm a professor at Columbia Business School and also a partner at QuantStreet Capital, as you've already heard. Okay, so enough of the introductory content. Let's dive into our material today. So I wanted to speak about several topics. And really, I'm viewing this as a 2-week presentation. So we're going to do the first part of it this week, and we'll do the second part of it next week. So I don't think we'll get through all of these topics today, although very unlikely. So what I want to discuss in the hour and a half today and what we have coming up next week are the following topics. I want to talk about investment goals. So when you're thinking about investing in financial markets, what should your goals be? What are you actually planning to do? And what are you hoping to achieve from your investments? I then, before I talk about historical investment performance, I want to take a little bit of a detour and talk about risk in financial markets and how you would think about risk of investing and what tools we have to quantify the risk exposure of portfolios. Once we've established some of the concepts about risk in portfolios, I then want to give you some statistics about historical investment performance, just to give you a sense about what is a reasonable expectation for an investment portfolio and what is an unreasonable expectation. Once we've talked about what are historical benchmarks for investment performance, I want to kind of go back into the risk topic a little bit and talk about portfolio diversification. You've probably all heard the concept of diversification. You know, you don't want all your eggs in one basket, so to speak. You want to have a broadly diversified portfolio, so risks as much as they can offset. So I want to explain those concepts to you. And then I want to talk about financial products. So one of the things about financial markets in the US, as you probably will understand, is that there is an enormous number of financial securities that you can invest in. And I want to just walk through some of them and give you the background you need to have. So I see among the attendees there's a hand up. Is that a question from Wilma? I'm not sure if it's a question or not, but let me just pause for a second to ask if it is a question. Yes. Do you want to?
It's not a question.
Not a question. Okay. Just a raised hand. Okay, fine. No problem. Okay, so let me see if I can. Okay. So after I talk about financial products, I then want to talk about how you would think about constructing a portfolio. So what does it mean to have a robust portfolio? We'll talk about that, and then some of the supporting material of the presentation is going to be in the appendix. So that's where we're going with all of this stuff, and let's jump in. So in terms of investment goals, when we talk to clients at QuantStreet, one of the first conversations, one of the first things we ask them is, what are you trying to achieve with your investment account? And the answer to the question of what you're trying to achieve
I'm on a call.
can be different for different people. Actually, if everyone could mute, that would be very good, so we don't have a lot of background. Or if the call host could mute the participants who are not actively speaking, that would be great. Thank you. Okay, so what I wanted to sort of emphasize is when we discuss, the starting discussion with clients about how we should structure their financial plan, their investment portfolios, what are you trying to achieve? And we can think about sort of what you're trying to achieve, that concept, as having potentially three dimensions. So the first of those dimensions is liquidity. When you have a client who is saying, I may need to buy a car at some point in the future, but not too far in the future, at some point imminently, I may have to pay for kids' tuition, either school or college tuition, a down payment on a house. I want to have some money set aside for a vacation that we're going to take in 6 months, or in case a tree falls in the garage and it's not covered by insurance. So the liquidity component of the investment portfolio should consist of very safe assets, things like treasury investments, or if you have a money market fund, the really safest types of money market funds that invest in U.S. Treasury securities. And what the liquidity account is supposed to do is to support the spending needs and anticipated and maybe even unanticipated expenses without being exposed to market fluctuations. So part of the investment goals discussion is just trying to understand what are the liquidity needs that a person has. The second component, which applies to some people but not to other people, is how much can you spend from your investment account. So if you are working and you're saving money, you're obviously not spending from your investment account. But for people who are retired or who are partially retired, maybe working, part-time, they may be at a point in their life where they're trying to, spend some money that they've already saved. And there you have to really figure out, what is like a safe spending rule. We won't delve into this too much in our discussion today and next week, but I just wanted to give you 2 links. So we'll share a PDF file of these slides with all of you later on. But there's a link here. There are 2 links to Schwab and Morningstar, which give you a more detailed, in-depth discussion about this idea of being able to spend 3.5 to 4% of your wealth every year without depleting your account. But that's typically the spending range. And again, of course, the less that you spend from your account, the more your account can accumulate over time, so that generally when you can avoid spending, you do. But in some cases, of course, people need to spend, in which case the 3.5 to 4% rule is sort of what rules the day in that case. And the last component of the investment account is capital appreciation. So the way we want to think about this is everyone would like their investing account to appreciate as much as it can, obviously, because having more saved is better. But there is a very difficult trade-off involved with setting up accounts that have high levels of appreciation, because typically the higher the appreciation level, the anticipated return or appreciation level in your account, the more risk the account typically has. So there's a distinct risk-return trade-off that needs to be thought about in terms of how fast you expect your account to grow in terms of returns. And the way we like to sort of frame that discussion is to ask people at what level of risk are they comfortable with. And the risk measurement that we prefer for that discussion is the concept of drawdown, which I will explain to you later on. So I'm going to return to this idea of invest subject to a comfort level with the drawdown risk in the portfolio in a few minutes. And ideally, what you would like is, if you are saving, to have your account grow as quickly as it can. If you are retired and you're spending money out of your account, what you would like to see happen is that the account appreciation after spending whatever you're spending from the account should at least have the account keeping pace with inflation, or ideally even growing a little bit faster than the rate of inflation. So the real value of your account doesn't deplete over time. And in fact, maybe the real value of the account increases over time, even though you continue to spend from your account in retirement. So, so those are the general investment goals that we might think of as applicable to a given investment plan. And it's important, before you sort of engage in your investing journey, to really figure out where your needs are along these dimensions of liquidity, how much you need to spend from your account in the steady state, and how much capital appreciation you expect from your account, subject to a risk level that you're comfortable with. In terms of how it all lays out, you can think about the account structure that you have in your overall portfolio as looking something like this. Most all of you will have what are called qualified or tax advantaged accounts, and then non-qualified or taxable accounts. And what I would encourage everyone to do, by the way, and we do this for all our clients kind of day one, but I actually find not everyone does this for themselves, and I think it's a pretty good idea to do it, is to just set up a spreadsheet that keeps track of all of your accounts. Again, not hard to do, but it's surprisingly useful to just have a spreadsheet where you type in across all the accounts you might have, and I'll discuss some of these account types in a second, just to know, what you have invested in those accounts, how much, what the risk level is of all of the accounts, just so you have it sort of in front of you. And even simple things like, some people actually forget that they have certain accounts. We'll talk to clients and I'll have a conversation with them, tell me about your investment accounts, basically this slide, and they'll sort of think and say, oh yeah, I remember I have this old IRA account that I haven't looked at in 10 years, and yet I have it, and let me try to log in, and usually they forget their password, so they have to reset the password or whatever. So it's generally a good idea to keep track of all of these things. So I would encourage you to do that. In terms of the kinds of accounts that you have available, most everyone will have a 401k at work. So 401k is an account that you contribute. Usually the way 401ks are structured, you contribute pre-tax money. It grows tax-free. When you withdraw money in the future, you have to pay income tax at the then prevailing income tax bracket for yourself. People may have 529 accounts, which are kids' college savings accounts. People may have IRAs. IRAs are often can be 401ks of old employers that you transfer into an IRA at your brokerage firm. Sometimes people who are self-employed can start their own IRAs. So IRA is another type of qualified account. And then perhaps the most advantageous type of qualified account is called the Roth IRA. The Roth IRA allows you to contribute post-tax money, so money in which you've already paid income taxes, but once they're in the Roth account, they can grow. The capital gains are not taxed. The dividends and interest payments are not taxed. So it's very advantageous to keep your money actually in a Roth IRA, but there are limits on how much you can contribute to a Roth IRA of $7,000 a year, with some exceptions for older people. And also, you're not allowed to contribute to a Roth IRA at all if your income is above a certain pre-specified level, which in like the mid 100,000 sort of range. And you can find the exact numbers, which change year in and year out online. So that'll be sort of your universe of tax advantage accounts. On the taxable side, people may also have multiple accounts, but generally, the way we like to set it up for our clients is to have two separate accounts. One of them we call the liquidity account, and we think of the liquidity account as containing things like very safe bonds, maybe some very safe municipal bonds, treasury bonds, treasury bills. Treasury bills are like treasury bonds that have a 1-year maturity or less. So the liquidity account is very safe, sort of yield generating assets. And then the growth account is going to be your sort of main or the core sort of taxable investment account that'll have usually a big stock exposure subject to your comfort level on the risk side. And the growth account is supposed to be what sort of gives you the appreciation over time. And the liquidity account is what's supposed to give you, the house down payment, the car payment, et cetera, that you may need in the short term. So that's generally how we think about the accounts being laid out. And again, I would encourage you, if you haven't already done it, to just make a simple spreadsheet, write down all the accounts you have that your spouse has, and just keep track of them. Update it maybe quarterly, maybe semi-annually or annually, just so you know sort of what your amounts are in all of these accounts. And again, you would be surprised how many people don't do this. And it's pretty straightforward, and it'll give you a lot more clarity into what your investing profile looks like. Okay, so what I want to talk about next is a kind of a detour from discussing, investing. I want to talk a little bit, to give you a few concepts, a little bit mathematically, I was going to say, but not really a lot of math, but a few concepts of how to think about risk. Okay, so let's talk a little bit about risk in your portfolio. So when you're investing, it is crucial to understand the risk characteristics of your portfolio. Financial markets have risks. Stocks go up, stocks go down, bonds go up, bonds go down. Any investment you can think of, real estate, private equity, venture capital, any investable asset, cryptocurrencies, if you are in a venture into that part of the investment universe, all of these things have a lot of risks. And I want to talk to you about the historical performance of a lot of these asset classes, and I'm going to use terms like volatility and drawdown, and I just want us to be all on the same page in terms of what these terms mean, because I want you to really understand the intuition behind those historical numbers and not just give you a number that you're not, you won't have an intuition for. So professional investors use many different measures of risk. And I'm not going to go through all of them. There are just innumerable measures of risk. But I want to mention two in particular that are going to be, I think, very useful for you to be able to understand financial markets. One is volatility. And volatility is going to be a measure of the variation, sort of the day-to-day, month-to-month variation of stock, bond, or a portfolio return. So I want to give you a sense of how to think about that volatility number. And then I want to talk about drawdown. Drawdown is a measure of the size of large losses in a portfolio. So volatility is a measure really of local risk, like how much does your portfolio fluctuate day to day, up and down. Drawdown is a measure of that, the really big risk that might be embedded in your portfolio. I feel a lot of people have a more intuitive understanding of drawdown than volatility, but I want to show you both measures because both of them are used by the financial media, by mutual funds, like retail-facing investment products use these terms, and I want you to understand what they mean. So to give you a intuitive sense of volatility, and then I'll give you a little bit more of a mathematical explanation in a second, I want to just give you a feel for what volatility looks like. So what you have here are three different return series. So there's one that's yellow, one that's red, and one that's blue. All of these series have an average return of 8%. So if you take, imagine these are annual returns. If you average all of these annual returns, each one of the points in this graph for each of the three lines, you'll find that all of them have an average of right around 8%. Or at least I created this simulation under the assumption that all of them have a average return of 8%. So these three series have the same average return. But the volatilities are quite different. The 4% volatility series is the blue line. And the meaning of 4% in this context is how much the returns fluctuate around their average level of 8%. And so what you see when you have 4% volatility, the degree of fluctuation isn't very high. In fact, the entire range of outcomes in this 4% volatility series is something between, just eyeballing it, like this point here would be maybe a plus 1% return, and this point here maybe a plus 15% return. So it would seem to be here that the majority of the 4% volatility outcomes are the mean return plus or minus something like 7 or 8%. So that's the blue line. And by the way, this level of volatility is roughly corresponding to what you might expect to see when you invest in medium duration treasury bonds, like 3, 4, 5-year treasury bonds, maybe 5-year treasury bonds would have a level of volatility of about 4% on average. When you go to the 10% volatility series, that's the red line, what you see is that the amount of variation around the mean increases. So you can see that the worst outcome of the red line was a loss of about minus 10%. And the best outcome of the red line was a gain of maybe in the high 20% range. So whereas the blue line ranged from maybe like the mid-teens to the low single digits, the red line ranges from minus 10% to plus something like 25 or 30%, even though both series were created with the average return of 8% a year. When you go to the 16% volatility, so that's the yellow line, what you see is that the amount of variation around the mean becomes even bigger. So if you have 16% annual volatility, that's now in line with what you might expect to see in the stock market. So stocks often move with a volatility of about 16%. You then see the range of outcomes becomes dramatically bigger. Again, the average is 8%, but the worst case outcome is now minus 20%, and the base case outcome is about plus 40%. So in the case of a 16% volatility, what you begin to see is that the range of outcomes that you might see out there in any given year is like your average return, but now plus or minus, not 8%, but plus or minus something like 30%. So it can go from the 8% average to minus 20% or plus 30%. So your range has now gotten much, much bigger than it was at the 4% volatility series. So what I want you to take away from this slide is just an intuitive feel for what that volatility number means. Volatility is telling you like the range of outcomes your portfolio can achieve over the course of many years. And the higher the volatility, the bigger the range of outcomes. Both on the positive side, you could have very positive returns, which would be good, but also on the negative side, you can go through years of having extremely negative returns, like you had here and here and here and here. And those years, if you're an investor and you're actually checking your portfolio balance every week, every month during that year, it's painful to live through those years, and then especially if you need to spend money. So if you didn't set aside money in a liquidity account and you were planning to sell your stocks to pay for a down payment in a house, and the stock market that year was down 20%, well, you're going to be selling your stocks at a very unattractive level, and obviously that sort of locks in losses. So hopefully this gives you a little bit of a sense of the kind of range of outcomes you could see with different volatilities of different asset classes. So let me just repeat, if you have any questions, please feel free to unmute yourself, ask questions. I would be more than happy to make this interactive if you would like. Okay, so that is a volatility. Now, I want to give you a little bit of a second intuition for volatility based on the normal distribution. So this is, for those of you who have heard of the bell curve, this is the bell curve, which corresponds to the frequency of outcomes you would expect to see if returns were normally distributed. I'll mention that stock returns are not normally distributed, and I'll talk about the way that they're not normally distributed in 1 second. But the normal distribution, the sort of bell curve count of the frequency of different return outcomes, is actually not a terrible approximation of what the reality looks like, even though it's not a perfect approximation. It's not a terrible approximation either. So what I want to show you is what the frequency of outcomes would look like in a return distribution that had a mean of 7.87% and a standard deviation of 14.11%. And the reason I use those numbers is because I'll show you in a few minutes, those numbers correspond to the historical returns of the stock market over the 400-year time period from 1629 to 2015. The average stock return over that time period was 7.87% per year, and the volatility of returns was 14.11% a year. So we'll discuss these numbers in a minute, but I first, again, just want to establish the intuition behind what these numbers actually mean. So in order to get the intuition for the meaning of these numbers, the average return, the 7.87, is represented by that blue line. So it's the peak of the distribution right here. So the most frequent sort of outcome, although it doesn't happen that often, but it is the most frequent outcome of all the outcomes, is to have a return that's right in line with the average return of 7.87% a year. But this only happens occasionally. In any given year, you can have a return anywhere given by this distribution. So it could be here, it could be here, it could be here. And the higher the curve is, the higher the bell curve, the more likely a given outcome would be. The single most likely outcome is a return equal to the average return, but then you can be any of these other outcomes is also fairly likely, and any of these outcomes is fairly likely. So what that green bar is showing you is the range of outcomes that are one standard deviation, so 14.11% above or below the mean. So if the mean is about 8% and you go 14% below 8%, you get to something like -6%. And if you go 14% above 8%, you get to 22. So the range of return outcomes that are all relatively likely to happen, that are one standard deviation above or below the mean, ranges from something like -6% to +22%. And in the normal distribution, the amount of time you have an outcome that's one standard deviation within the mean is 68% of the time. So if returns were normally distributed, what it would mean is basically 7 out of every 10 years would have a return in that year that falls somewhere in the range of this green bar, somewhere between -6 and +22%, like the mean plus or minus a single standard deviation. And by the way, I should also mention that the term standard deviation and volatility I'm going to use interchangeably. So the volatility of returns is exactly the same thing as a standard deviation of returns. I should add that to the slides so it's totally clear, but just so you know, the standard deviation and volatility are identical concepts. So 68% of the time, 7 out of every 10 years, you're going to be one volatility band away from the mean in terms of outcomes. What the red line shows you, this line, is a range of outcomes that are two standard deviations or two volatility units away from the mean. So if you look at two volatility units away from the mean, it takes, if the mean is 8% and two standard deviations is 28%, it's something like from minus 20% up to 8% plus 28%, which is like 36%. So somewhere between minus 20 and plus 36% is the range of outcomes that are two standard deviations away from the mean. And according to the normal distribution, being two standard deviations away from the mean should happen roughly 95% of the time. So this means 19 out of every 20 years, the return on the broad stock market in the US should be somewhere between minus 20% and plus 36%, somewhere in that range, 19 out of 20 years. Now, in reality, we end up observing many fewer negative return years than the normal distribution would suggest. So returns are, in fact, not normally distributed in reality. In reality, we see more observations on the left side here, which people refer to that as a fat tail of the distribution. It means the tail of the actual distribution, that sort of left edge of it, is above the where the tail of the normal distribution would be. And when people talk about stock returns being not normally distributed, what they really mean to say is that there are more of these negative outcomes than you should observe based on the normal distribution. When we talk about drawdowns, that'll be exactly talking about those kind of very negative outcomes. And so we'll discuss that in a few minutes. So I hope that the prior chart and this one are giving you some sense about, or some intuition for what it means to have a certain return volatility. So if you have an 8% return volatility, it means you're within the mean, you're 8% on either side of the mean 68% of the time, and you would be 16% on either side of the mean 95% of the time. And so the bigger the volatility, the bigger is the range of possible outcomes. The smaller the volatility, the more bunched up the returns will be around the average return. So those bunched up volatilities are usually associated with bond investments, especially short-term bond investments, like things that are 2-year maturity bonds, 3-4-year maturity bonds, whereas the bigger range of outcomes, both on the upside and the downside, is typically associated with stock returns. And I'll show you the exact numbers in a few minutes. Okay, so if there are no questions, and I don't see any, I'm going to move on. So what I want to explain to you next is the concept of a drawdown. Okay, so volatility is a measure of kind of the local fluctuations of outcomes around the mean of the outcome. So it measures, like, how dispersed will even small outcomes away from the mean be around the mean. The drawdown is a measure of really the tail risk of a portfolio. So let me walk you through what a drawdown would mean. So in this example, the portfolio achieves its maximum value of $100 at the end of year 5. And then it falls from year 5 to the end of year 6 from $100 to $75. So in terms of percentage returns, the portfolio experiences a minus 25% return from year 5 to year 6. That 25% return is what we call a drawdown. So we would say that the drawdown of this portfolio in this between year 5 and year 6, the portfolio experienced a 25% drawdown. The other salient feature of drawdowns is how long do they last. So by length of drawdown, what I mean, so if the drawdown happens here between years 5 and 6, the portfolio loses its peak to trough loss in value is 25%. You may also then ask the question, well, how long does it take for the portfolio to get back to its prior peak? And in this example, after the portfolio experiences a 25% drop from year 5 to year 6, it takes 1, 2, 3, something like 3.5 years from the trough of the portfolio to get back to its peak. If we measure the amount of time the portfolio spent in the drawdown, which means from the prior peak to the new peak, it was a period of 4 years. So this is the prior peak, and then you have 1 year, 2 years, 3 years, 4 years, 4.5 years. So when we talk about drawdowns, you can think of the drawdown as having really two components. One of the components of the drawdown is what is the peak to trough percentage loss in the portfolio. In this case, it would be 25%. And the other component of the drawdown analysis is how long does a drawdown last? And in this case, a drawdown, we would say, lasted 4.5 years. So when I show you some statistics on drawdowns, keep those two sets of measures in mind. One is the size of the drawdown, and the other one is the length that the drawdown took before the market returned back to its prior peak. Okay, so we've now discussed two important risk concepts that we will now use in our subsequent discussion. One of those concepts is the concept of volatility, which is a measure of kind of the local fluctuations a portfolio has around the mean. And the other one is the concept of drawdown, which is what is the peak to trough loss of the portfolio, and what is the peak to trough loss of the portfolio, and how long does it take to return back to that level, to the prior peak. Okay, so with those concepts established, let's look at some of the historical evidence on what stock performances look like. So one of the reasons this is really important is because in financial markets, you will often come across people who may be overpromise and underdeliver. They may try to entice new investors by promising them, returns of 20-30% a year with very little volatility, and make those kinds of claims. Are those kind of returns achievable? Maybe in incredibly rare circumstances by the very best investors the world has ever seen. Those kind of returns might be achievable over a short period of time. For the vast majority of investors, they cannot achieve those kind of returns. So I want to give you some benchmarks about what kind of returns would be reasonable. So the data that I'm going to show you come from an academic paper which appeared in the Journal of Financial Economics, which has the title 4 Centuries of Return Predictability. All of the data in this table are annual data in nominal terms. Nominal means the data are not adjusted for changes in inflation over the life of the investment in the stock or bond market. So they don't convert. They're just done in terms of the currency without making any adjustments for what happened to inflation. Okay. Just to give you a sense of what these things are, when it says T-bill rate, the T-bill rate is a rate of return on short-term investment in safe government bonds. So like a 3 or 6 month T-bill. Think of that T-bill rate as something that you could earn in a high-yielding savings account. So right now, if you find like a high-yield savings account from the few banks that offer them, you may be getting a return on your savings account of something in like the mid to high 3% range. And in fact, that's been the historical level of the risk-free rate over the time period considered here. So this column shows you the return characteristics of U.S. stocks in the post-World War II time period. And the rightmost column shows you the return of 3 global stock markets, the UK, the US, and the Netherlands, basically spliced together over time, where in any year of the sample, the researchers took what was then the biggest global stock market, which was the Dutch market, the Netherlands market, followed by the UK market, followed by the US market. So in turn, each of those represented the biggest stock market of the world. So in the post-World War II period in the US, the average return on stocks in the US has been 12%, with a standard deviation of 16.87%. So keep in mind, the standard deviation refers us back to the bell curve. It tells us that in the post-World War II period, if US stocks were normally distributed, which they're not, but it's not a terrible approximation, what you would have seen is an actual return within 16.87% of the 12% mean, about 68% of the time. And then you would see a return within 2 standard deviations, up or down, from the mean, 95.5% of the time. So about 1 in every 20 years would be outside of that band, and 19 out of 20 years would be within 2 standard deviations of that mean. The average return on T-bills over the post-World War II era in the US has been 4% a year, which is exactly where they are today, actually. So right now, T-bills are exactly at their historical average level. And the dividend growth is sort of just an interesting thing to know. The dividend growth tells you by how much does the dividend the stocks pay grow every year. So when you buy a stock, I would say the majority of stocks pay you a dividend. Think of it as like a little return to shareholders that they pay every single year. Today on the S&P 500 index, which is sort of the main index of the US stock market that tracks the US stock market, the dividend yield is about 1.3%. So for every $100 you invest in the S&P 500 index, you're getting a $1.3 dividend. In the post-World War II era in the US, that the per share dividend paid by a broad index of the US stock market grew at 6.4% a year. So it means if you were receiving $100 in dividends this year, next year, if you didn't sell any of your investments, you'd receive $106.38 of dividends. So dividends in the post-World War II era in the US have grown at that rate. In the longer time period, so the 400-year time period that started in 1629, the return of global stock markets was not as good as the return that US stocks have had post-World War II. So one thing you should keep in mind is that the post-World War II time period in the US has been an extraordinarily good one for investing in stocks in the US. The US has been sort of the global leader in stock market performance over the last 80 years or so. Over a longer time period, returns don't look quite as good. So historically, the return from investing in the stock market was about 8%, 7.87%, with an average T-bill rate. So the rate of investing in a riskless, like high yield savings type account was 3.5%. And the historical volatility was 14.11%. So this picture, that bell curve, which shows you the range of possible outcomes given a mean of 7.87% and a volatility or a standard deviation of 14.11%, is exactly just referring to this historical data. So if someone is promising you an investment vehicle that has returns considerably higher than these numbers, you should be a tad skeptical, and you should really ask that person to explain to you where the returns come from. And one possibility for where they might come from is the investment portfolio you're looking at might be taking on an awful lot of risk. So you have to be sort of cognizant of how much risk you're taking on in your investment portfolio in order to achieve the kind of returns that are being promised. So it's something very important that you understand this, both to have a decent sense of what is the historical range of return outcomes, and furthermore, when someone is offering you a prospective return, that's out of whack with this range, you at least should be asking them the hard questions of, well, explain to me how you can generate such extraordinary returns. Okay, so the next thing I want to discuss is the concept of how risk and return are tied together. So let me explain to you why there is this trade-off in the first place. So one of the core findings of the theory of financial economics is that higher risk assets should earn higher returns on average. The reason they should earn higher returns on average is because those returns are compensation. Those higher average returns compensate investors for taking on the greater risk of a riskier investment. If you were offered 2 investments and one had very little risk and one had a lot of risk, if both of those investments had the same expected return, you probably wouldn't want to invest in the investment that had a high level of risk, because you would say, why am I taking on this much risk just to earn like the same level of return as I can from a more safe investment? So in order for the very risky investment to be attractive to you, it would have to offer you a higher return than the safe investment. So there should be this relationship between the amount of risk you're taking in your investment and the anticipated return you will get by investing in that asset class. A useful way to think about portfolios and the risk levels is to think of portfolios as consisting of some portion of stocks and bonds. And you can think about, you can describe a portfolio by just giving, by knowing the fraction of the portfolio that's invested in stocks and what's invested in bonds. So for example, if you talk about a 60-40 portfolio, 60-40 portfolio would be a portfolio where 60% of it is invested in stocks and 40% is in bonds. You could have an 80-20 portfolio. So intuitively, an 80-20 portfolio would be riskier than a 60-40 portfolio because it has a higher allocation to stocks, which are a riskier asset class than bonds. You could have, a 90-10 portfolio, even a 100-0 portfolio. So 90-10 would be a portfolio that's like 90% stocks, 10% bonds. 100-0 would be something that's all stocks. You could also have less risk. You could have a 50-50 portfolio. You could have a 20-80 portfolio. So 20-80 portfolio would be 20% stocks, 80% bonds. So that would be very conservative portfolio. So historically, what's happened is the more bond-heavy portfolio, so think of like the 50-50 portfolio that's half stocks, half bonds, is safer than an all-stock portfolio, but also earns lower returns on average. And portfolios like 80-20, 90-10, or all-stock like 100-0 portfolios have historically earned higher average returns, but are also riskier. So there is this theoretical trade-off between risk and return, and it's not only a theoretical trade-off because when we actually observe outcomes in financial markets, we very much see that trade-off playing out, where the higher return investments tend to be riskier, and the lower risk investments tend to have lower returns. What's really important is that you invest in a portfolio, or that you structure your portfolio to have an investment level that you're comfortable with. So the last thing you want to do is have an investment portfolio that has basically too much risk in it, not be cognizant of how much risk your portfolio has, only to then see the market have a massive sell-off, and then see your portfolio also sell off along with the market, and then realize only, at the bottom of that big market sell-off, oh, I can't believe my portfolio had this much risk. I never intended it to be as risky as it turned out to be. And I feel so uncomfortable with my portfolio that I now will sell out of my stock investment just so I prevent the portfolio from losing any more money, and then move into cash or move into bonds at the very bottom of a big market sell-off. Because at that point, you're converting what might be a temporary drawdown into a permanent drawdown, because you're going to sell the assets in your portfolio that have a chance of recovering. So it's very important that you put together portfolios before the big market sell-off happens that are at the right risk level for your own preference and sense of comfort, which will vary across different investors. Some investors will be very willing to take on investments that have a lot of risk, and other investors will be unwilling to take on investments that have a lot of risk. So a really useful way to think about this trade-off between the return and risk of portfolios is the following visualization. So let me just explain to you what this chart means. Each of the dots on this blue curve corresponds to a different stock bond mix portfolio. So the 100-0 portfolio is effectively an all-stock portfolio. The 80-20 portfolio is a portfolio that's 80% stocks, 20% bonds. 60-40 would be a portfolio that's 60% stocks, 40% bonds. 40-60 would be sort of the flip side of that. It'd be 40% stocks, 60 bonds. And 20-80 would be a portfolio that's 20% in stocks and 80% in bonds. What is shown to you on the x-axis, so here, the numbers from about 6% to a little under 12%, is the average return of each one of these portfolios using data, the average annual return of these portfolios using data from 1993 to 2024. Now, a caveat here, each of these portfolios is a specific type of 80-20, 60-40, 50-50 portfolio. So you could construct other portfolios that have 50-50 mix that might have different return profiles than these. These are a representative set of portfolios that we put together at QuantStreet, but I think they demonstrate what would be sort of the broader point, which would be true, I think, however you constructed these portfolios. So on the x-axis, you have the average historical return of each of these portfolios. On the y-axis, you have the maximum historical drawdown that each of these portfolios experience. So I'm going to talk about that maximum drawdown in a second and give you some more statistics about that. But what I want you to notice is that there is a distinct upward pattern in this curve. So the higher risk portfolios, like the 100-0, 95-5, 90-10, these portfolios all have a similar feature that they have had historically high average returns, but they've also had the highest historical drawdown. So for example, the all stock portfolio had an average return of about 11.3% a year in the time period from 1993 to 2024. But the maximum drawdown of that portfolio, so its worst peak to trough loss, was actually about 50%. It means if you had, $100,000 invested in this portfolio, you in the worst sort of market outcomes from 1993 to 2024, you would have lost something like 50% of the value of your portfolio. In fact, that drawdown, that 50% drawdown, actually happened twice. It happened once during the dot-com bubble, starting from like 2000 to 2002. So the markets, or maybe from 99 to 2002, the market saw, sorry, just for making a note, the market saw that 50% drawdown, and then it happened again. It happened during the global financial crisis of 07 to 09. So the market's peak, I think, was in October of 07 of 2007, and the market's trough was in early 09, and that peak to trough loss in the US stock market was about 50%. But the historical average return of that all stock portfolio has been about 11.3%. As you go down the risk spectrum, if you look at the 60-40 portfolio, it's had a lower average return than the all stock portfolio. Its average return has been something like 8.5% a year, so almost 3% lower than the all stock portfolio, but its drawdown was also considerably lower. So it had a maximum drawdown of something like 32% instead of the maximum drawdown of this all stock portfolio, which was closer to 50%. So as you continue to move down in risk level, like you go down to the 20-80 portfolio, so this portfolio over this time period has had an average return of something like 5.8%, but it had a maximum drawdown of only 15%. So unfortunately, we don't have a lot of evidence that says you can construct very high return portfolios that have very low drawdowns. That's not what the data look like. In order to have the higher average historical returns, you need to put in a portfolio that has the higher tail risk or the higher drawdown risk. So what I like to tell clients when they invest with us is you have to look at this range of drawdowns, like this chart, and just tell me, like, what are you comfortable with? Like if you invest, say, $1 million, or whatever amount, like your entire life savings, and that investment loses 50% of its value. Are you going to be okay with that? Are you going to say, okay, well, I invested $1 million, it's down to 500,000. I'm okay with that. I'm still saving, and I know that this'll, or I hope this loss will correct, will be made up over the next few years, and I'm just not going to do anything. Like my portfolio is down 50%. I don't like it, but I'm not selling. I'm just leaving it alone. I mean, I'm going to sleep solidly at night. It doesn't bother me. If that's where you are, that might be appropriate for you. Most people I talk to are not comfortable with a 50% loss in their portfolio. Some people will say, look, okay, I'm willing to take a 32% loss in my portfolio, maybe maybe even 40% or something, but I don't want to be at that 50% loss range. And so depending on your own sort of introspection and the loss that you would be comfortable experiencing on your life savings is sort of going to determine, where you are on this range of outcomes. If you're very risk averse, like we have some clients who don't want to be above maybe 20-25% maximum drawdown on their portfolio. So that means that their investment has to be something like 40% stocks or so, maybe a little more, maybe a little less, but it can't be much higher than that. And then we have some clients who are still working, who are saving, who may have other accounts besides what they have with us. And for them, if what they have with us experiences a 50% drawdown, they're okay with it. So for those clients, we have the more risky investments for them. So when you're thinking about how to invest, I think it's absolutely crucial that you look at a chart like this one and make yourself comfortable with the risk return trade-off that's in your portfolio. And again, as I said, the last thing you want to do is go into a big market sell-off with a portfolio that's too risky, then have it massively sell off, and then be so uncomfortable with what's happened in your portfolio that you sell out of everything at the bottom of the market at the absolutely worst time. And the way that you guard against those risks is by putting on the appropriate risk level investments today, because once the market actually has sold off, it's kind of too late. So this table shows you the same results as the chart that I just showed you. And one thing I should note, by the way, that's also really important is these average returns are calculated over a time period that was a really good time period for the US stock market. So from 93 to the end of last year. It is very likely that going forward over the next 10 years, the risk numbers might be appropriate. So the market might realize the same kind of risk levels, but the return that we have seen from 93 to 2024 may not be the return that we see over the next 10 years. In fact, I would be very surprised personally if stocks returned 11% per year over the next 10 years based on where valuations are today. I think a number like maybe in the high single digits would also be an attractive but achievable return. I think an 11% return. You never know, but it's a tall order given where valuations are today. And I'm not bearish on the U.S. market at all, but I also just want to, be cognizant of the fact that we have seen a very high return time period, and what might happen in the future may not be as good. So you should be aware of that. But the other dimension I haven't shown you about these portfolios is the length of the longest drawdown. So I showed you the size of the biggest drawdown. Remember, so what we've discussed so far is this peak to trough loss. And what I want to show you now is how long it lasts. So I now want to tell you how many years pass from the prior peak to the time the next peak is reached, after we've already seen the peak to trough percent loss. You've already seen. Let's talk about the length of the drawdown. So in the all stock, the 100-0 portfolio, the length of the drawdown in this 30-year period in the US market has been about 6 years. So again, it really happened twice. It happened during the dot-com bubble from like 99 to 02, and the global financial crisis from 07 to 09. In both of those cases, the market sold off, and it took about 6 years until the market came back to its prior high point. So not only are these higher stock portfolios risky in the sense that they can experience a large drawdown, but the length of those drawdowns, so how long it takes until the market reachieves the prior peak, can be quite long, as long as 6 years. If you look at a 60-40 portfolio, the length of the longest drawdown was only 4 years, so 2 years shorter in a 60-40 portfolio than it was for an all stock portfolio. And then if you look at the even safer portfolios like the 20-80, the 20% stock, 80% bond portfolios, those had a drawdown of something like 2.5 years. So the second dimension of risk in these portfolios isn't just how much the market sells off, but how long it takes until it gets back to its prior peak. And that ranges for the portfolios that we analyze here, from like 2.5 years to as high as 6 years, a little over 6 years, in terms of the market returning back to its prior peak. So again, when you're constructing your portfolios, it's very important that you think about not only the average return, which is what people often focus on, but also the volatility of the portfolios, the maximum historical drawdown of the portfolios, and also the length of the drawdown, like how long might the drawdown last, and are you going to be okay in terms of your spending needs, liquidity needs, what have you, if the market experiences one of these very protracted drawdowns, which are not hypothetical. These actually happened twice over the last since 25 years ago in the US. So we've seen 2 drawdowns of the magnitude of 50% a year, both of them having lasted about 6 years. Okay, I will remind you one more time. If you have any questions, please ask. I would be very happy to answer questions at this point in our discussion, and if not, I will continue. Okay, so the next point that I wanted to make is about diversification. So let me motivate diversification with the following example. What I'm showing you here is the value of a $1 investment in 4 different asset classes starting in the year 2000, and then what the value of that investment would have looked like about halfway through 2025. So if you had invested $1 in the US stock market, in the S&P index, this includes what you would have received in dividend and price appreciation income, that dollar would have grown to a little bit over $7 over the 25-year period starting in 2000. So that's if you invested in the US, that's the black line. If you invested in emerging markets, that's the green line. The dollar you invested would have grown to something like 620, which is a good return, but a lot of that return was earned in the first few years of the sample. In fact, since the peak of the emerging market sort of stock run, which happened right around the time of the global financial crisis, I think it peaked in 2007, the return of that market from this point forward has been very meager. Like if you had invested at this point, your total return over the next almost 20 years now would have been very unfavorable compared to what would have happened if you hadn't been investing in the US market. The red line is the global stocks excluding the US. So this red line consists of an investment in countries like China, Japan, Germany, the UK, Canada, Australia, and so on. Basically, the rest of the world, excluding Switzerland, excluding the US. $1 invested in non-US global stocks would have grown over the subsequent 25 years to something like $3 and I don't know, like 33 cents. And then the blue line is what you would have had by investing in a broad bond index of US bonds, including government bonds and mortgage-backed bonds and some other types of bonds. $1 invested in bonds would have grown to something like $2.50 over the subsequent 25 years. So there are several notable features of this data that I want to show you. One is if you just look at the fluctuations in the series, what you see is that the blue line has very low fluctuations. And the reason it has low fluctuations is because bonds have low volatility of returns. So similar to that simulation I showed you, bond returns don't fluctuate that much because they have lower volatility. Of the stock series, so US, the black line, global non-US is the red line, and then emerging market is the green line. Of those, the one that seems the most volatile are emerging market stocks. You see they can have severe price swings, much greater than the kind of price swings we see in the US or internationally, excluding the US. So one difference of this series is the fact that stocks are more volatile. Within stocks, emerging market stocks tend to be more volatile than the stocks of developed market economies. But the other thing that you might notice is the degree to which the stock markets move up and down together. So you can see that there was a great run, like a great bull run after the end of the dot-com bubble sell-off, which ended in like, I don't know, 2002 sometime. And then all the global stock markets sort of went up together. Emerging market stocks went up, international ex-US went up, and US stocks all went up. And then starting with the global financial crisis, they all went down again. So you had EM sell off, international ex-US sold off, the US sold off, then they all went up, then they sold off, then they sold off again, then they went up. Then you had a big sell-off here of all the markets. So you had EM, US, international all sell off. That was the COVID sell-off. Then all the stocks rallied together, and then all the stocks again sold off. This was the inflation-driven sell-off we had in 2022. So EM, emerging markets, US and international ex-US, they all fell in value. And then from that point, they all rallied. So in addition to the fact that the stocks tend to be more volatile than the bonds, the other salient feature of the stock return series, as you can see from this, is that they tend to co-move with one another. And that co-movement is actually a really important feature of stocks that I want to discuss next. So the way we think about co-movement is by a measure that's called correlation. What is it a correlation of? It is a correlation, in this case, of the monthly returns experienced by these four asset classes. The correlation is a number that goes from minus 100% to plus 100%. And the way to think about it is when the correlation of two asset classes is 100%, they tend to move perfectly in sync with one another. So, for example, the following series have a correlation of 100%. Because when I set up the simulation in a way that these three series, the 4%, 10% series, these volatility series, all had a correlation of 100%. So 100% correlation means things perfectly can move. When one goes up, the other one goes up. When one goes down, the other one goes down. They don't have to move by the same magnitude, like one can move more, one can move less, but they tend to co-move perfectly in sync with one another. So those three series give you an example of 100% correlation. If series have 0% correlation, it means that they have no tendency to move up and down together. Like sometimes they move up together, something moves up and the other one moves down. Sometimes this moves down, then this moves up. Sometimes they both move together, sometimes up and down together. But most of the time, their movements tend to have nothing to do with one another. You can think of this as like you're flipping two coins. They're two fair coins. The fact that one comes up heads tells you nothing whether the other one will come up heads or tails. So when you do two coin flips of two separate fair coins, their outcomes will be what statisticians would say independent of one another, and they would have a zero correlation. A correlation of minus 100% means things perfectly co-move in opposite direction. So when this goes up, this always goes down. And then when this goes down, this always go up. So minus 100% means things are perfectly moving in complete sync, just opposite to one another. So to give you a sense of what these correlation numbers look like in the wild with real data, what the green bars are showing you here is the degree of correlation between these different asset classes. So for example, US and international stocks have a correlation of monthly returns of 86%, which means that on a month-to-month basis, the movement of US and international stocks tracks each other quite closely. If you look at US stocks and emerging market stocks, their correlation is 74%, so a little bit lower than US and international stocks. If you look at international stocks and emerging market stocks, their correlations are 91%. So the important thing that you see here in these numbers is the numbers exactly capture the tendency of those lines that we visually saw to co-move with one another. So the fact that the green line goes up and the black and the red lines all go up together and that they all fall together, the way it's reflected mathematically is to say that those series have a high correlation. The other notable thing about the return series that we're looking at here is that bonds, so that's that blue line, have actually a very low degree of correlation with the stock market. So it's not zero. They do move up and down together, but the tendency of stocks and bonds to move together isn't very high. The correlation of US stocks and this bond index is only 12%. which means to a first order approximation, they basically move independently of one another. It means that when stocks are up, bonds have a 50-50 chance of being up or down, and vice versa. So they co-move a little bit, but not very much. And that's true of bonds with all of the other global stock market indices. The reason correlation is so important is because when you're constructing a portfolio, which is something we'll talk about next week, what you would like to put into your portfolio are assets that have a very low degree of correlation. And in the best case, they have negative correlation, but it's very hard to find assets that are negatively correlated with one another, but you can find assets that have low correlations like stocks and bonds. And the reason it's so attractive is because when you add together securities that have low correlations into a portfolio, the fact that they don't perfectly co-move tends to cancel out some of the risks of each one of the asset classes. So for example, if you have stocks and bonds and you get lucky and then one day stocks are up and bonds are down, well, your portfolio level in that day is sort of flattish because one move offset the other move. If stocks are down, bonds are up, stocks are up, bonds are down, the risks are offsetting. Even if only stocks move and bonds don't do anything, still the move in the stock market is dampened because it only represents a portion of your portfolio and not all of your portfolio. So the fact that things don't perfectly co-move leads to something called the diversification benefit of a portfolio. So let me show you how to think about that. So this is, by the way, Jim Cramer. I think Jim Cramer is a very smart guy, and I listen to him all the time. And he has a show called Mad Money. And he often talks on his show about investors who are, self-styled stock pickers. And he talks about, how do you diversify the right way? So he talks about like, how do you create a properly diversified portfolio, which what Cramer says is to have a well-diversified portfolio. You should have in your portfolio something like 10 to 20 stocks, and that gets you a diversified portfolio. And his argument is that if you're an individual investor and you are a stock picker, you're not going to be able to follow closely 100 stocks because you just don't have the bandwidth to do that. So practically speaking, you could follow between maybe 10 and 20 stocks. And that's what you need to get your portfolio to be nicely diversified. So let me show you how to intuitively think about portfolio diversification. So this chart, which I'll explain to you in a second, is an example. It's not a real portfolio, it's just, I think, a good example of how diversified a portfolio could become when you add more securities to it. So what's shown on the x-axis is the number of stocks that are in the portfolio. To construct this chart, what we basically assumed is that you have many stocks you can invest in. All of that have an annual volatility of returns of 15%. And each stock has a correlation with the returns of every other stock. And the correlation that we used in this analysis was 70%. I am 95% sure it was 70%. It may have been a slightly different number, but it was around 70%. So here's how you read the chart. On the x-axis, you have the number of stocks in your portfolio. So right here, you have a one stock portfolio. Because every stock in this example has a volatility of 15%, a one stock portfolio would have a portfolio level volatility of 15% because it only has one stock. As you add more stocks to the portfolio, the risk of the portfolio itself begins to drop. The expected return of the portfolio, the anticipated gain you make in the portfolio, actually doesn't change by investing more stocks in the portfolio. So that's sort of the magic of diversification. It doesn't decrease your expected return, but it decreases the portfolio level risk. And the reason it decreases the portfolio level risk is because in practice, the securities that you can put into this portfolio don't have 100% degree of correlation. And because they're not 100% correlated, when you have a portfolio of many stocks, a lot of their local day-to-day, week-to-week, month-to-month movements tend to offset to some degree. And so at any given point in your portfolio, you have some stocks that are randomly up and some that are randomly down, and those random up-down moves offset each other. On average, all those stocks may be up, whatever, 6%, 7% a year, whatever is their average return. But on a day-to-day basis, a lot of the fluctuations are offsetting one another. And so having a bigger portfolio gets you this diversification, and it decreases the risk of your portfolio. So as you go from one stock to two stocks, the portfolio risk drops from 15% to about 14.7%. Again, how do we think about this volatility? This is why the volatility graphs are so important. We think of it in the context of this simulation. So if we can drop the volatility of our portfolio from 15% to 12%, it means the range of outcomes, like the amount of fluctuations we're going to see year in and year out, is going to be smaller. And the range of outcomes that we have in our portfolio around that mean outcome is also going to be smaller. And as an investor, what we would like to have is less volatility. We really would like to have the amount of variation that our portfolio can experience around its average return to be as low as possible, because we dislike that variation. We certainly like the positive aspects, like we like years that are positive, but we really, really hate years that are negative. In fact, we dislike, because we're risk averse, in what economists would call utility terms, we dislike these negative return years more than we like these positive return years. So net, we really dislike volatility. So because of this interpretation of volatility, the amount of dispersion around the mean, what we would like is to construct portfolios that have as small as possible degree of volatility. And the cheapest way we can of achieving that without sacrificing return is to have a diversified portfolio. As you go from one stock to 10 stocks in the portfolio, the volatility of the portfolio, so that measure of its year in, year out fluctuations, drops from 15% to something like 12.8%. As you go from 10 stocks in the portfolio to 20 stocks in the portfolio, so this is somewhere around Kramer's sweet spot, the risk drops even more, although not as much as it did initially. It drops from maybe, I don't know, like just eyeballing it, 12.5% to maybe something from like 12.7% or 12.8% to maybe 12.6% or so. So you have a little bit of a drop in risk. As you go far above 20, actually the amount of diversification, the drop in the risk of your portfolio still happens, but it's not very meaningful. I mean, like as you have 20 stocks, the portfolio has a risk level here, call it 12.7, and when you go to 50 stocks, so you more than double the number of stocks in your portfolio, the risk level falls from like 12.7 to 12.6. So you get a little bit of a risk reduction, but not as big a risk reduction as you get when you go from one stock to 10 or 15 stocks in your portfolio. So to sum up this part of our discussion, Kramer is exactly right. Your portfolio becomes close to being fully diversified when you own stocks in that 10 to 20 range. And if you are investing in broad like market indices, like the S&P 500 index or the NASDAQ 100 or the Russell 2000 or a mid-cap index or an international index like the ACWI, which is the MSCI All Country World Index, those indices will not be invested in 20 securities. They'll be invested in hundreds or thousands of securities. So the S&P 500 has 500, but the ACWI, which is this All Country World Index, probably has in the thousands of securities. So those indices are so attractive because they give you this built-in diversification. So they've already reduced a lot of this idiosyncratic risk of owning individual securities. A lot of that risk cancellation has already happened by the time that you move to a broadly diversified portfolio. Okay, so let's just like recap what we've covered so far. So I've talked to you about investment goals, which is you have to think about what is your liquidity needs from your portfolio. Do you need to spend money from your portfolio? And what kind of growth do you anticipate your portfolio having? We talked about risk measurements, the two important risk measurements being volatility and drawdown risk. I gave you statistics about investment performance. So over a very long time period, over a 400-year time period, the global sort of major stock market has returned 7.87% per year with a volatility of 14%. It's been higher in the post-World War II period in the US, but that US exceptional performance period has been quite unusual in the historical context. Usually returns have been a little bit lower than that. In terms of investment performance, I also discussed with you the risk return trade-off. So as you go into an all stock portfolio, it's had historically high average returns, but also very high drawdown risk. As you go into lower stock mix portfolios, they've had historically lower returns, but they've also had considerably lower drawdown risk. And so that's really advantageous for you as an investor. And then we talked about diversification. Diversification happens because stocks tend to co-move with one another, but they don't co-move perfectly. So you can reduce the amount of risk in your portfolio without sacrificing expected return just by having a broadly diversified portfolio of stocks, as opposed to being invested in only a few stocks, which for the vast majority of individual investors, you should never, ever do. You should never have a portfolio of 5 stocks or even 10 stocks because it's like too risky. You should have really very broadly diversified portfolios. I showed you in the chart that you get a lot of the diversification benefit when you have 20 stocks, but frankly, there's no reason for individuals to even own 20 stocks in their portfolios with, access to low cost, highly diversified financial products like index funds and mutual funds and ETFs. Individuals can have, beautifully diversified portfolios at very low cost. And that would be my strong advice for the vast majority of people. So what we have coming up that I don't want to get into now because it's going to introduce a brand new topic, and I just think we'll sort of lose focus on it over the next week. But what I want to talk about next week when we see each other again are different kinds of financial products. So here I'm going to talk a little bit about what are stocks and bonds, which I've sort of mentioned to you so far without really giving you all the definitions. I also will define for you what are mutual funds, what are exchange traded funds, how do they differ from one another. I'll talk a little bit about alternative investments like private equity and what the issues are there. I'll then talk about fees. So when you buy different financial products, they have very different fees associated with them. So I want to explain to you very clearly how much fees you'll be paying to people when you invest in different types of products. We'll have the fee discussion. And then I want to talk about portfolio construction. So we already talked a little bit about portfolio construction today when we talked about diversification. So your portfolio should be highly diversified, but there are many other dimensions of portfolios like using leverage and short selling and trading a lot. And I want to give you some information about those portfolio characteristics. I will briefly talk about evidence on forecasting financial markets. So what evidence do we have that you can kind of time portfolios of when to be in a certain asset class, when to be out of a certain asset class. And then finally, I'll talk a little bit about how you would think about working with a financial advisor, and then share some information about reading materials and places where you can learn more about some of these very interesting questions. So let me finish here. So let me just pull up one last bit of information about QuantStreet. So this is our email list. It's bit.ly/QuantStreet. If you're interested in this stuff, we have a monthly newsletter. We put out actually often twice a month. We'll write about investing. So if you want to talk to us, just sign up here or send us an email at hello@quantstreetcapital.com. And then when I see you next week, hopefully you'll all come back and tell your friends and bring them along with you. We'll discuss some of the, I would say, more advanced topics, but hopefully today we laid the foundation for thinking about some of the more advanced things and higher level concepts that we will be discussing next week. So let me stop here. I'm happy to stick around if anyone has any questions. If you don't, good evening, and hopefully you will come back next week and we will finish up this little 2-week tutorial on investing this same time, just 1 week from today. So I will pause and take any questions, and otherwise have a good night, and I'll see you next week.
Any questions? Okay, seems like
Oh, I
question.
do.
Oh, you get one.
Yeah.
Yeah, please just unmute and
Hello, Professor. Thank you. I just wanted to say this was a very informative presentation that you gave. Very much looking forward to next week's. One question I was going to ask, but I think you mentioned you're going to cover it, was about where we are in the business cycle and sector rotation and how that plays a role in portfolio construction.
Okay, why don't we touch on that next week? But I mean, where we are in the business cycle, just briefly, we are several years into an economic expansion that really began after the very severe recession we had during COVID. The latest data that we're seeing on the job side is pretty good, and the consumer side is pretty good. Delinquency rates in the U.S. are decent. So we are there's some evidence of slowdown in growth, a little bit of job weakness, a little bit, but we're basically in a fairly decent part of the business cycle. Of course, unusual things can happen, tariff and trade wars and all this stuff. But we are several years into an expansion, and the stock market is at an all-time high. But GDP growth is slated to be okay. Some of the worst case outcomes that were predicted to happen from the trade war have not materialized. The AI revolution, which I spend a lot of my time thinking about, is very much for real. To some extent, it's reflected in valuations, but I do think the AI boom will lead to strong productivity gains. So I think we're in a decent part of the business cycle for the time being. Of course, that can change and recessions come on very quickly. But as of right now, this point in time, the data are looking okay, if not the best ever. They're looking okay. So I can bring some charts for next time and show you, time permitting, visually some of the things that I just mentioned.
and I would suggest if anyone has any question and a suggestion for next week, you can all email me and I'll forward them, your questions to Professor Mamaysky, then you can, discuss next week. How's
Great.
that? Okay, thank you very much. I hope you all come back next Thursday at the same time. Thank you all. Good night.
Thank you all. Take
Bye-bye.
care.